one of the maybe misconceptions about inflation is that it is only driven by monetary policy. Obviously, monetary policy has a big effect, but you recently wrote a piece about fiscal-driven inflation. Maybe you could expand on that a little bit and explain why is the fiscal component so important given the inflation we're seeing right now?
Sure. So a big theme I've had actually for a couple of years now is that the inflation that we're going to get, which now we have, is in large part driven by fiscal spending. And the difference, for people that don't know the difference, monetary policy is like what the central bank does. It's like, what are interest rates going to be? Are they doing quantitative easing or quantitative tightening, that sort of thing? Whereas fiscal policy is basically about taxing and spending by Congress and the president. And especially when you get extreme fiscal policy, unusually large multi-trillion-dollar deficits, that actually puts money out into the broad money supply. And so if you look back at, say, the 2008 crisis, for example, there was a large monetary response. So we saw the base money go up quite a bit, but most of that just stayed in the banking system. It didn't actually really circulate to the general public. It's not like you and me got checks sent to us that we could then use to buy things, right? So it's not like people had more purchasing power. There was not a realistic version of more money chasing same goods. Whereas what we saw in the 2020 response was, in addition to the monetary response, we also had things like helicopter money, PPP loans that turn into grants, basically just tax cuts that are not offset by anything else. And so that was a large injection directly to people's bank accounts in different ways. We also saw corporate bailouts, for example. And so in that type of environment, you actually have a broad money supply increase. There's actually more money that people can control chasing the same number of goods and services. And of course, the monetary policy is still relevant because they're printing money to buy the bonds that is enabling the fiscal expenditure. Because if they try to just issue trillions of dollars of bonds, they'd have problems with like liquidity. Like there wouldn't be enough buyers showing up to buy those treasuries. And so the central banks are monetizing that fiscal. So it's really that blend of monetary policy and fiscal together, as well as, of course, real world constraints that we've run into, right? So the fact that we had underinvested in, kind of physical goods like, oil capex and things like that for a few years was also the supply side of this whole inflation thing.
Is it fair to break down the most simplistic analysis being monetary policy drives liquidity into the financial system, but fiscal policy drives liquidity into the hands of people? And because we got both in 2020, the monetary policy drove the asset bubble and the fiscal policy drove the inflation. So kind of all items went up in price. Some of them were investment assets. Some of them were consumer goods and services. Is that a way to break it down? Or could the fiscal policy actually have also had an impact on the asset prices going up as well?
I think you described it well, but I would say that fiscal impacts both. So I think that monetary policy, specifically QE, putting liquidity into the system is generally pretty good for financial assets, whereas fiscal policy is basically consumer price inflation, as well as because that consumer price inflation is resulting in more revenue and things like that for various businesses, at least in nominal terms. It's also generally good for asset prices in nominal terms. Whether it's in real terms is another story. And a good example of this is Japan, because if you look at their QE, I mean, they did more QE as a percentage of their GDP than like any other major country. I mean, they have, their balance sheet's over 100% of their GDP, whereas the United States, it's like, under 40%. And it looks like a Weimar chart if you look at their base money, but because it wasn't combined with huge fiscal expenditures, I mean, their broad money supply actually went up pretty slowly this whole time. And if you look at Japan, so they're well known for like their 30-year bear market, where their equities are still literally like cheaper than they were in the beginning of the 90s. But that wasn't like a sideways market. I mean, you had a couple decades of downturn, and then starting around 2012, Japan actually had a pretty strong equity bull market. It was like one of the outside of the U.S., it was one of the better performing equity markets over the past decade. And that's specifically when their QE started really ramping up in 2012. They started printing a ton of money in 2012, they never really stopped. And that included for them, unlike the Fed, buying equities. And so if you look at Japanese equities from 2012 and you look at their QE from 2012, there's a pretty strong correlation with that being very good for their equity market. But it wasn't consumer price inflationary for Japan because, again, it wasn't combined with things like helicopter money or things like that.